Hi guys, welcome to Savvy Money Show. Me, host Sean. Now we're going to do a series of value stocks because I've been asked to do an ETF. For those of you who don't know, or a bit younger than my channel, I used to create ETFs, like genetic ones, value ones, dividend ones, and what's so. Anyway, I stopped doing that because I had my ETFs, so I've been asked to redo and reevaluate them. What are they based on? Well, these will be over a few videos. The ones towards the end of the videos, it'll be done on a couple of things such as income statement, cash flow, and the likes. The newer ones are going to be overall valuation. Anyway, let's get into it. Let me know whether you agree with them or not. I'm going to start with ones that are a bit off the beaten track, and you can tell me what you think. Now, we're going to start with one that I've spoke about before, QYWI. Don't expect a lot of growth with this. It's a payment processor, foreign payment processor, PE ratio of 2.44, dividend of just under 15%. Now, you're going to get a bit of growth, forward PE of just under 1, although Yahoo Finance is not showing it. Price to sales of 0.87, price to book of 0.9. Now, another one I've spoken about before. I'm not going to spend too long on these ones I've spoken about before. You can go back and see them on the videos. Is CBD. PE ratio of 3.2. Dividend of 13%. Remember, these dividends, high dividends, can be cut at any time, so do not rely on them. Market cap of 1.1 billion versus enterprise value of 2.27 billion. And price to sales 0.12. Price to book 0.47. It's based in South America. It has supermarkets there in Peru and the likes, in multiple countries. And this isn't just a drop. They did sell off some of their business, but it has online and in store. Anyway, that's all I'm going to spend on that. Don't forget to hit that lovely like button, and don't forget the sexy subscribe button. A lot sexier than me, just ask the wife. And if you want to be a hero, hit the bell notification. You'll be notified when a new video gets uploaded. And why not check out the links in the description below. If you're looking for a free trading platform, you get a free share with up to £200, depending on the platform you use if you deposit a small amount. American Eagle Outfitters, PE under 13, 3% dividend. You have market cap under enterprise value, forward PE under 10, price to sales of 1.07, price to book just over 3. We have Dell Technologies, market cap 44 billion, enterprise value just under 72 billion, PE just under 7, forward PE just under 7. So not much growth there, but price to sales 0.43. So sales wise is going to be steady. It's not going to be something that blows you out of the water, but it's going to be something that, you know, it's a steady value stock. And then we move on to Citigroup. Now the problem with this is that it's not able to buy back its own shares at this valuation, because in my opinion it is good valuation. PE ratio is 6, dividend of 3%, and it's got a price to sales of 1.74, price to book of 0.66. Now you've got Ozon. Now, I spoke about this before. It's a Russian e-commerce stock. Now this is one of these that I'm using as an example. A year and 2 years ago, when you look at like the first couple of them, a year and 2 years ago, the market cap was half of the enterprise value, price to sales was under 1, and price to book was, and it had the dividend, it had high dividend. Now it doesn't have either of that, even though it's half the price it was during the pandemic. So beware of some of these stocks. SG Fleet, 4% dividend and 16 PE. Now, has a forward PE of 10, price to sales of 1.32, price to book of 2, and got SFL. Trying to get as many as possible through, that's why I'm rushing. There's a dividend of 8.54% and has trading P under 15, forward P of 8, and its market cap is less than half of its enterprise value. Price to book of 1.34, price to sales 2.35. Now, Pennant Park floating rate capital, 8.5% dividend. Dividend will go ex-dividend soon, so you'll have to jump on that if you are. P ratio of 9, and market cap is 60% of the enterprise value. Of course, price to book of 1.03, price to sales is fairly high, but you see that in the forward PE it's at just under 12. You have IFL as a 5% dividend, price to book 0.96, price to sales 1.73, forward PE of 11, and Fluent, which if you look at it, has a price to sales 0.59, price to book of 0.88, forward P of 14, and Flowtech, which although has a high PE, it has a low forward PE, and the market cap's below the enterprise value, 80 mil against 100 mil, and price to sales of 0.78, price to book of 0.92. Flurry has a 4% dividend yield, market cap is a half enterprise value, PE of 44 isn't too good, but what is good is the price to sales 0.14 and price to book of 0.64. And we move on, we can see that we have Flex with under 9 PE, and we can see price to sales 0.34, price to book 2.32, market cap 8 billion against 10 billion enterprise value. Now we have Fletcher Building, which is 20 PE, 4% dividend yield. So I'm trying to put a mix of dividend and value in, but it has a forward PE of 13, price to sales of 0.73, price to book of 1.5, and the market cap is 5.5 billion versus enterprise value of 7.25 billion. Now we have Fleetwood, which is a 6.79% dividend, as a market cap is above the enterprise value, P of 16, forward P of 30, which isn't too good, but then the price to sales is 0.65 and price to book is 1.02. And one I spoke about already, Blue Ridge Bank shares, 2.64% dividend, P of 6. If you found any of my videos helpful and you'll want to help me make more, you can support me by buying me a coffee. The link is in the description below.